Thanks, Ben. All right, are we there yet? Well, the short answer is obviously no, with inflation at 4.7%. But yes, we've made some good progress. So, starting with the elephant in the room, obviously we were wrong about what the RBNZ would forecast. The forecast was one thing we did get right. Was the forecast weren't that different, but obviously they didn't hike, but the whole tone of the document was a lot more chilled than we were anticipating, given they got another upward surprise on non-tradable inflation, another downward surprise on unemployment, and some of the pricing indicators still looking pretty sticky, but nonetheless they sounded a lot more relaxed that they've got this. So they really sounded like they did not want to hike, whereas November they sounded like they had a pretty itchy, tricky trigger finger. So we've got to respect that. So we've taken the hikes out of our forecast, but as you can see, the newly dovish, or at least much less hawkish tone, has seen the market now pricing 3 full cuts pretty much. I think it's about 70 something points priced in by the end of the year. So the swaps curve has dropped quite a bit, and we've actually seen some pretty meaningful cuts in mortgage rates as well. And the RBNZ will have absolutely known this was going to happen. So presumably they are comfortable with that easing in monetary conditions that they've brought about. We would say that a 5.5% OCR remains highly conditional. We hope that's the top, and if everything continues to go right, then it will be the top. But there is still a long way to go, and so far the progress has mostly been in the low-hanging fruit. But that said, the evidence is accumulating that that inflation is sticky, but also that monetary policy is definitely working to cool the economy. So in that, I think that is at the heart of why the Reserve Bank sounded more relaxed. They put quite a lot of weight on that weak Q4 GDP. Now, of course, we'll get Q3 GDP. We'll get Q4 next week. We would say the RBNZ's been quite sensitive to those GDP outcomes. Where the Q2 was surprisingly strong, we thought, okay, that's cyclone bounce back and noise, but the RBNZ put quite a lot of weight on it, and we're in November saying, where's our impact on the economy? And then, of course, the next GDP came out weaker. Probably still a bit of noise in there, but that I think was a big contributor to the RBNZ being confident that the OCR is doing the job. So let's look at what they said. So in November, they discussed the possibility of the need for increases to the OCR. In February, nothing. But yet the first question in the press conference was, did you discuss a hike? And the answer was yes. Doesn't sound like they discussed it at length, but they did discuss it. So they could have repeated that statement, but they chose to take it out. And very deliberately. There's no accidents in the language that they choose. In November, some members noted inflation's been above target for some time. There should be a low tolerance for any increase in the time to return to inflation to target. In February, there was an increase in the time to return inflation to target. A little one, but still it was there. But they said risks to the outlook of inflation are now more balanced. The split of inflation, now, we took from November that they're very much focused on domestic inflation, because they said tradable inflation can be volatile, cannot be relied upon to achieve the inflation target. Non-tradable inflation is easing only gradually. It's basically, since they called a pause in May, that non-tradable has fallen at roughly half the speed that they were expecting it to have by now. And we thought that would, really be a big deal. All core measures of inflation have declined, but still elevated. The last month, they said inflation was lower than expected in the December quarter. Both tradables and non-tradables inflation fell, with tradables inflation falling by more than expected. They didn't choose to say that non-tradable inflation fell by less than expected. That didn't even warrant a mention. Whereas we thought that would be a pretty big deal. So they said, well, basically, looking back at what we thought in May, CPI inflation has fallen like we thought it would. Okay, the mix is a bit different, but whatever, was kind of the tone. Very, very different to May. We agree, to November. We agree more with the November thing. You can't rely on tradable inflation. A move in oil prices, a move in international airfares, a move in the currency, all of these things that are not within the control of monetary policy at all, can see that thing turn around very quickly. On migration, in November, while population growth has eased supply constraints, labour supply basically, the effects on aggregate demand are becoming apparent. This is increasing the risk of inflation remaining above target. In February, they said they acknowledged both sides that it's deflationary for wages but inflationary for rents, but just sort of noted it rather than sounding worried about it at all. And I think that is because the Q4 GDP was weak. There's clear evidence that the consumers are indeed cooling their jets. And then on the OCR, they said ongoing excess demand and inflationary pressures are of concern. If inflationary pressures were to be stronger than anticipated, the OCR would likely need to increase further. That was missing. They just said need to remain at a restrictive level for a sustained period. Now, technically, the OCR peak of 5.6 is still nearly half a hike in their track, still suggesting, on the face of it, a bias towards the next move in the OCR, still potentially being up. But the language didn't support that at all. So the market is not pricing any chance of a hike now. And obviously, if they did turn around and hike in April or May, that would be a massive surprise to everybody. So in that regard, I think the market's completely right to price out any chance of a hike in the near term. But there is still a scenario where it turns out that the low-hanging fruit isn't sufficient. That inflation is sticky. I'll show a few indicators that just show why we're still worried about that, even though the market is not. It is still a possibility. We still see two-sided risk around the OCR, though we're no longer forecasting hikes. Our forecasts are the same pretty much as everybody else's. I mean, there's just nuance, and when we see cuts, we said, well, if you're not going to hike, then it's going to the trade-off is you have to hold rates higher for longer. So we don't actually have any cuts in our forecasts until early next year. But that's a year off, and no one can forecast a year in the future. So absolutely take the details of that with a grain of salt. But the theme is that if you're not going to hike, then you will have to hold for longer. So New Zealand inflation hasn't had the worst of it globally, but we haven't had the best of it in terms of getting it down either. You can see we've become a bit of a laggard, and it's not just because our inflation's only quarterly. We have actually had stickier inflation than many. If you look at the top left chart, most of the progress has been on that tradable inflation. So that's normalising oil prices, shipping costs, goods prices generally globally. All the stuff that's brought inflation down everywhere. But the domestic inflation, I guess a glass half full interpretation would be that the speed of decline is accelerating. If you look at the fall in those bars, a glass half empty interpretation would be that it's barely fallen and it's still much higher than in any point in the 2000 cycle when the OCR got to 8.25. So still a long way to go. That said, it is entirely reasonable to expect it to fall and pretty steadily from here, because obviously things are deteriorating. We had a fall in GDP in Q3. Everyone's expecting it to be flat or thereabouts in Q4, and the labour market is cooling dramatically, and partly as a result of the cooling economy, but partly as a result of the massive surge in labour supply. You boost the supply of something, and while demand is weak, you will lower its price, or at least reduce the rate at which the price is increasing. So it should take a lot of heat out of wages. But on the right-hand side, you can see a couple of slightly worrying things that I don't think the Reserve Bank looks at, or at least doesn't use in their model. Pricing intention. So the proportion of firms who say they're going to raise their prices in the next 3 months. Now, this was the bomb in 2020 and 2021, and we didn't listen to it. We laughed at it, saying, that suggests inflation's going to 7. And it was exactly right. So rightly or wrongly, I am putting some weight on the fact that thing has gone sideways in the last 7 months. So basically, the proportion of firms who say they're going to raise their prices has been stuck around the 50% mark, whereas you can see from the pre-COVID period that about half that would be normal, about a quarter of firms planning on raising their prices. Costs, again, some flattening off. That downward trend has gotten a little bit stuck. Now, of course, if wage growth does drop away, then that presumably, particularly for services firms, will drop away more quickly from now on. But a very high proportion of firms, about 3/4, are saying they expect their costs to increase in the next 3 months, whereas the little bit of data we have pre-COVID suggests about half of firms thinking costs will increase in the next 3 months would be more consistent with a normal inflation period. So the economy is definitely cooling. So the uncertainty around whether what a 5.5% OCR would do to the economy has largely been resolved. It is clearly hitting the consumers quite hard. But there's a second bit of uncertainty, which is how much damage do we need to do to the economy to break the back of inflation? How embedded is it? How many people need to lose their jobs? How much pain do we need to have? There's actually a massive uncertainty around that as well. And this falling inflation is still a forecast rather than a fact in terms of it getting back to a target at 4.7. It's still very high. But yeah, things are going the right way though. On the tradable side, you can see shipping costs have had a bit of a bump, and the RBNZ talked about that as adding 0.3 to 0.7 to headline inflation, which is similar sort of back of the envelope to what we got. They said explicitly they will look through that because it's a relative supply shock. It's a relative price shock coming from the supply side. But they will only be able to look through that if it doesn't have any second round effects. So if they're going to rely on tradable inflation to get headline inflation down, then this sort of thing is potentially problematic. But you can see it's a pimple on a pumpkin compared to what happened in the COVID period, but nonetheless unhelpful. And the bottom left chart shows retailers are starting to experience a bit of disruption. But for it to be inflationary, you'd have to have shortages of goods, and demand is so weak that doesn't seem likely at the moment to get those second round effects. I mean, top right, food prices inflation in New Zealand. Yeah, you're not imagining it. It has been really, really high. Normally, it follows global food price inflation adjusted for the exchange rate. You could take that chart all the way back to 1990, and it's tight as a drum, but not in recent years. So that's an awful lot to put on one cyclone. So part of it's probably strong wage growth. There's obviously a lot of labour input into food production, distribution, and retailing. But anyway, it's now falling. And you can certainly see it in the fruit and veggie section, and should be a tailwind for bringing inflation down. Oil prices, bottom right, so far pretty unflappable, but obviously geopolitical risks are elevated. Anything could happen, and the Reserve Bank couldn't do much about it if it did, but so far it's fine. So why have we got such a overheated economy? So the IMF estimates New Zealand was the most overheated advanced economy in the world in 2022 by a country mile. They also estimate that was still true in 23, but GDP's been revised a lot since then, so I don't know if they would still reach that conclusion. But anyway, our boom was something, it was one out of the box. And basically, we had a massive policy error from both monetary policy and fiscal policy. And, I'm not throwing rocks here because our forecasts weren't any better. COVID was something that was really hard to predict, but we had fiscal policy that was hugely expansionary and very, very slow to turn. The IMF also has estimates of the fiscal position now versus COVID period, and New Zealand's fiscal positions barely moved really compared to many countries which didn't have the fiscal headroom we had, and so were forced to retrench on that fiscal expansion quickly. We've had very prolonged fiscal expansion. Of course, we've got a new government now, but they want to cut taxes as well as, they're already cutting taxes for property investors. They want to cut income taxes, and they want to build a lot of stuff as well. So they're stopping a lot of stuff, but they want to do a lot of stuff too. And so we'll have to wait and see, really. We won't really know until May. Interestingly, the Reserve Bank's monetary policy statement is a week before the budget, so they will know the numbers and will be able to take them into account, but they won't be able to talk about them. So that's going to be an awkward comms challenge. That's just because the budget was pushed out as late as possible. A couple more inflation indicators out of our survey. When those pricing intentions got to nearly everyone saying they were going to raise their prices, we thought, whoops, we need to add another question. How much are you going to raise your prices? So that's that data there. We don't have enough history or any turning points, so we can't say that means that inflation is going to do this. But what you can see is there was a downward trend that's flattened right off in the last 6 or 7 months. So it's not just the proportion of firms saying they're going to raise their prices, but how much firms say they're going to raise their prices has flattened right off. Costs, more of a downward trend, still intact there, I would say. I had to take agri out of these charts because poor old agri's got always seems to have the lowest expected prices and the highest expected costs, mucking up the chart. Wage growth, the Reserve Bank would be perfectly happy with those charts, I would say. Reported wage growth and expected wage growth, both still trending down. Again, that we don't have much data, but it does seem to match the QES measure of wages quite well, which is what you'd think. The QES is the cash in hand measure of wages. The LCI, the labour cost index, attempts to adjust for productivity. So the actual increase in the labour cost per unit of output for firms, it's a bit lower. So if you look at what households are expecting for inflation versus what firms are expecting to give for wages, you can see real wage cuts are now on the agenda, whereas over 2022, the opposite was true. So much less happy conversations this year. But that's what the Reserve Bank needs to see. Every 3 months, we ask firms what their biggest problems are. So we'll get another read on this later this month. So this is from December, so getting a bit elderly maybe. But the bottom 4 problems are all inflationary ones. Finding staff. We didn't add finding unskilled labour when we designed this question because it's not traditionally a problem, but with hindsight, we should have. Regulation and paperwork, high rates of pay, and then other costs. And you can see when the economy was so overheated, that was like 2/3 almost of firms' problems, but well over half. Now it's declined to less than half, and the next 4 problems, which are disinflationary problems, are grown. So low turnover, high competition. Those are both things that make it harder to pass your cost increases through into your prices. Interest rates, of course, the number of firms have debt, and cash flow and debtors. So yeah, the picture is turning less inflationary, as you would think. In our business outlook write-up, we reproduce this chart for each sector of the economy, which is quite cool. Thanks for a very colourful page. This survey, this is the QSBO, which is longer running. So similar question, what is it that's preventing your firm from expanding? And you can see we've had a 1970s redux here. You don't really want to resemble the 1970s if you can help it in any way. It has come back a lot, the proportion of firms saying labour is the main constraint. Dropped by less than one would have expected in the last quarter. In fact, the whole capacity indicators in both the labour report and the QSBO were much more mixed than we expected, actually, at the end of last year, given GDP growth was so weak. Some of them went the wrong way, in fact. But overall, big picture, you can see the number of applicants per job has exploded, for example, and it's a pretty consistent story from firms that they've got a lot more choice now. And of course, there are stories in the media about people actually, some firms, particularly in the retail and construction, actually cutting workers. So we're almost back to normal, but it's still high, actually. It's still like, what is that? 17, 18% of firms saying labour is the main constraint on their expansion, which is, not a weak story, but it is moving. So there's the GDP numbers. So you can see the light blue versus the dark blue that the Reserve Bank has revised down because of the starting point surprise, revised down their estimate of GDP growth quite a bit. And that's fed into a slightly more negative estimate of the output gap. So how much spare capacity there is in the economy, and that's fed into their confidence that they got this. Our estimate of that is not quite as weak, but we're all roughly on the same page that Q4 GDP was 0, give or take. We'll get out our preview later today. So the Business Outlook survey's been rising, not strong. I've standardised it here. But they're definitely rising. It actually troughed in late 2022 when the Reserve Bank hiked rates 75 basis points and admitted they were going to deliberately cause a recession. And ever since then, the theme of 2023 was, things aren't as bad as we thought they were going to be. So kind of a relief rally, I suppose, which isn't a strong story. And some of it might just have been that people didn't understand the lags with which monetary policy works. That tightening in 22 was definitely a factor in why Q3 GDP was so weak. It does take time for these things to feed through. But generally, the levels of these indicators are bad, actually. Some of it might be politics at the end there. But the improvement started well before that. But there is a real mismatch in the economy between what firms are saying if you ask them about the future and what they say if you ask them about the recent past. And it's the recent past questions that are best correlated with GDP, unsurprisingly. After all, firms know what just happened an awful lot better than they know what's going to happen. So we've added backward-looking questions to our survey 4 years ago. And so the beige one here is manufacturing, and it matches up with the PMI, which matches up pretty well with GDP. So it's not the different surveys, it is the backward-looking versus forward-looking. So you can see the gap there between manufacturers if you ask them about the future versus now. So are firms too optimistic and that's going to tank, or is it such the fact that things have bottomed out and are now going to rise, or is it a little bit of both? When I ask firms in my presentations, it's sort of roughly a third say the economy's recovering, a third say it's going down the gurgler, and a third say it's going sideways. So give or take. So this is a bit of spaghetti, but these are the backward-looking questions by sector. So you can think of it as a proxy for GDP by sector, really, given that the overall matches up pretty well. And you can see that construction in the brown and retail in the light blue had the worst 2023. of everyone. And services in the teal bouncing around the zero line, really. Very, very subdued. Very muted slowdown over 2023. And I think that goes some way to explaining why the labour market has held up so well, because services are a much bigger chunk of employment than they are of GDP. So, this would be roughly the picture the Reserve Bank would expect to see, that the sectors most sensitive to interest rates are having the worst time. Certainly, the economy is becoming pretty patchy in terms of the divergence between sectors, and that is, one word I can use with confidence about the economy is that it's patchy. So unemployment rose, but not as much as the Reserve Bank was expecting. But again, they sound quite relaxed about that. They keep pushing out their estimate of when unemployment will hit, say, 5%, and also lowering the peak slightly. So the upshot is, I think it's reasonable to interpret their unemployment forecast as what they think they need to see to get inflation down. And so basically they think fewer people need to lose their jobs to get inflation down. So that's great news if it's true, if it comes to pass. So the upshot is, looking at the supply side of the economy, there is a productivity recovery going on. I wouldn't call it a boom, but COVID obviously whacked productivity, not just in terms of social distancing at meatworks, but also the fact that the labour market got so incredibly tight that you just had to take anyone you could get, even if they didn't have the skills or the experience you were looking for, and that you were training them on the job, that comes with a productivity hit. Not to mention the question marks around whether they'll turn up on a given day. So now, of course, with the surge of migration, it's very low skilled, this wave of migration, but the work ethic will definitely be there, and so firms are reporting a productivity increase. So if that's true, then you can have more growth, more employment, more wage growth without that necessarily feeding through into inflation. So I think that's part of the story here. So wage increases are still very common, both at all and large wage increases. So, surely this is on borrowed time, given, you saw firms are reporting lower wage increases and lower expected wage increases, but it is probably fair to say it's been holding up longer than expected. So again, this is all that disinflation is still a forecast rather than a fact at this point, but the signs are that households have been really, really down recently. The consumer confidence, you can see, went off the bottom of the chart, had to keep extending the axis. Now, retail sales are not strong. You can pretty much draw a straight line between the growth in real retail sales now and where they were in the GFC recession, and that's quite something given the population's grown nearly 3% in the last 12 months. So per capita spending is very weak, and population growth is only partly making up for that. So retail is absolutely hurting, but consumers' confidence, that sort of Great Depression kind of stuff there. So what's going on? Basically, people hate inflation. You can see here these flip inflation upside down, and it beautifully explains consumer confidence. And that's despite the fact that the wage growth, real wage growth, was positive through a lot of that period. So households on average were more than being compensated for inflation. Nonetheless, they just hate it. So I think this goes some way to explaining why we ended up with inflation targeting in the first place. It's a political problem because voters don't like it. Some genuine good news: household debt is not as high as you would think, given the crazy housing boom we had. That's that little tiny bump at the end there that you can hardly see. How inflation does inflate away debt. People have got to hang on by their fingernails, but at the end of this period of high inflation and high nominal wage inflation, people will have much smaller debt relative to their incomes than they had beforehand. So it's not all bad for borrowers, but they do have to hang on, and obviously that's getting tougher for people. But the proportion of income that's going on paying the interest on your debt, which is almost all mortgage debt, troughed at 5%. It's going to go to somewhere a bit over 10 on our forecast by about the middle of the year. But just for contrast, in the last cycle, when the OCR hit 8.25%, that went over 15%. So while the change in debt servicing costs has been ferocious, people have gone from 2.5 onto 5 onto 7.5 on their mortgage. The actual proportion of their income compared to 2008 that people are forking out on interest is actually quite a lot lower. So it's not true that the Reserve Bank's putting an unprecedented burden on households, and also less than 40% of households even have a mortgage. The home ownership rate's been declining. So it's quite an uneven hit, that first hit, and now it's starting to widen through into wage growth and job security and affecting and small businesses, and it's affecting a bigger part of the economy. But that initial cash flow hit is quite concentrated, and well, amongst millennials who've bought a house in the last 5 years, really. So the effective mortgage rate has been gradually rising, but you can see there's a lag of more than a year. You can see the rate of increase is flattening off. We estimate it's going to 6.5, maybe a bit less now that mortgage rates are coming off. So we're most of the way there. So the maximum pain in terms of the change in pain, it should be coming pretty soon. Now the last chart that up there just shows the OCR is the zero, right? The overnight rate. That's the only interest rate the Reserve Bank controls. Out to 2 or 3 years, its expectations of where interest rates are going to be, where the Reserve Bank is going to set the OCR, has a huge impact. So you can see that people realise inflation's coming, the OCR is going to go higher, and that actually tightened monetary conditions. Fixed mortgage rates went up well before the OCR, and therefore floating mortgage rates did, and the OCR actually trailed the rest of the curve higher. So the market did a pretty good job of front-loading that tightening in monetary conditions. But now, of course, the market's saying, well, if you're not hiking, then you'll be cutting soon. So the market's starting to anticipate cuts, and therefore we're starting to see fixed mortgage rates fall well before the OCR. And the Reserve Bank's obviously comfortable with that, but it is an easing in monetary conditions. So I guess this just explains why why the Reserve Bank picks its words so carefully, because on a given day, the change in their forecast and the change in their words can actually have a much bigger impact on financial conditions, monetary conditions, than the actual decision on the day. We've got 80%, 90% of mortgage debt is fixed, and that increases the importance of those longer rates. Beyond sort of 5 years, it actually depends an awful lot on US data, which is a little bit crazy. US labour market data can have more impact on your mortgage rate than the New Zealand data at times, but that's markets for you. Immigration, massive incomings, massive outgoings, like 250,000 in, 500,000, 800,000 out, massive net. So yeah, the Reserve Bank, as you saw, is sounding more chilled about it. They do estimate it as net inflationary, but not in a big way. Obviously, a lot of these migrants are not going to be in a position to buy a house legally or financially, but they will need to rent one. And so it'll be interesting. We're not building many houses now, so we're eating into the housing stock again, which is our normal modus operandi, undoing the progress that we made during COVID. It's pretty serious in the likes of Auckland, Tauranga, Queenstown, but really housing shortages are a national problem. There's the housing cycle, boom, bust, crash, smack, wallop, and we all just dusted ourselves and cough and carried on. So you might have thought my OCR forecast error last week was spectacular, but in 2021 we were forecasting house prices to fall 20% and they went up 30%. So there you go. That was quite a common forecast error, but the Reserve Bank made the same mistake and eased the LVR restrictions, which was a massive mistake in hindsight. So yeah, house prices went up 50% in 2 years, went down almost 20%, and there was no real blood on the floor, which is just incredible. But again, that's the inflation. This is the wheels of a relative price adjustment. Nominal house prices did 16% of the work, and then inflation did another 9% or whatever. So basically undid, in terms of house prices relative to incomes, undid all the COVID damage to affordability. With at the peak, only 7% of people were in negative equity. Of course, we haven't solved our housing affordability problem. House prices would have to tank a lot further to get real housing affordability back to where it was in the early 90s, when young people could actually afford to buy a house. But that is probably, a case of be careful what you wish for, because it would take an awful lot of jobs with it if the housing market did that. So in terms of what drives housing markets, the model says migration is important, but as noted, this migration cycle could be different. LVR restrictions are important. That's the yellow for investors in particular, and the RBNZ is going to ease those. That's not in this chart. The green blob is all the tax and policy changes that the National Party is busy unwinding, so that's going to turn to a positive green blob. A net present value spreadsheet would suggest that the changes just to the interest deductibility was probably worth $13,000 to $16,000 on a $1 million investment property if you're 80% geared. So that's going to reverse. It's not that much, but Yeah, it's a tailwind. The best indicator for house prices is the auction clearance rate, Barfoot and Thompson. It captures competition even when sales are low, and at the moment it's going nowhere fast, and that is our forecast for house prices too. But yeah, I just never trust the Auckland housing market to stay dead. So definitely it'll be interesting to watch because the Reserve Bank does think the wealth effect is alive and well. So if they raise their forecast of house prices, they'll be raising their forecast of consumption. But not our expectation that it's about to go anywhere. But there are a lot of tailwinds actually. But the big headwind is the fact that the interest rates, while lower, are still much, much higher than they were last time house prices were at this level, and going up. And the deteriorating labour market tends to be quite toxic for the housing market as well. Builders are much more positive now, but consensus is still falling. So the Reserve Bank requires a prolonged slowdown in construction to get those construction costs down. But if we don't build enough houses, then the pressure will come through in rent. So you can't. There's no easy fix to the inflationary side. The demand side impacts on housing of that migration. But yeah, it's been an emotional roller coaster for builders, but they do seem to be more positive, and the maths is changing. It's still hard, but it is improving. Fiscal policy, as I mentioned, we'll have to wait and see. We'll get the budget policy statement this month, but the budget in May is the biggie. Reserve Bank's not sure where neutral is. No one is. And they have to take a punt. It's just worth noting how much it can move through time. In 2007, they estimate the neutral OCR was 5.5, which is where it is now. And obviously, we can see the OCR as having a big impact on the economy. But to the extent these neutral rates are rising and inflation's still high, and the longer inflation spends above target, the more inflation can become normalised into the likes of wage expectations or people's perception of what a good mortgage rate is. So there is that risk that the wheels could be slipping a little bit. The Reserve Bank's revised up their estimate of the long run neutral OCR, which is kind of where it would settle when all the dust has settled, by 0.5% since they stopped hiking in May. So unfortunately, these things are completely unobservable and also wildly uncertain. Look at the range around their estimate. It's nearly 300 basis points wide, which if you took the extremes of that range, which obviously they would view as much less likely, but just that would mean the OCR could be equivalent to 4 or equivalent to 7. So I'll just say the main point of this chart is there is a bit of a spurious accuracy in the debates we have about where the OCR should be. Should it be 25 higher? Should it be 25 lower? Whereas really should be a percent higher, percent lower would be a more reasonable range that we should be actually debating. But yeah, it's pretty unpleasant experience being out of the consensus and wrong. So there is a bit of groupthink that happens. For sure. So good news is dairy prices are back above break even. Of course, farmers still won't be making a buck, and it's also because of weak supply rather than strong demand out of China, but we'll take it. Meat producers still doing it pretty tough though. So a pretty tough external environment generally. A proportion of exports going to China is still very high. China's economy's got lots of problems, rising youth unemployment, a property sector that's finally capitulated after years of being used as a lever to juice growth, and a lot of malinvestment, apartments built in silly places. And their population is shrinking rapidly now because the one-child policy is 30 years old. So the number of women of childbearing age has plummeted like a stone in the last 5 years, and so is the number of babies being born. So people are drawing parallels with Japan in 1990 when their property bubble burst and their population peaked and they went into years of deflation, which they're only just coming out of now. So yeah, there's pockets of strength like EVs, for example, but the focus seems to be moving away from GDP growth and more towards geopolitics and independence and pulling away from the US and that sort of thing, and generally a move left. But I mean, they're so enormous. Opportunities will always be infinite, but fair to say it's hard yards for exporters at the moment. Equities, bond yields on the left are confident that the Fed's got this and they'll be cutting by June. Their inflation tonight will be really important because it has had a little flurry lately, and everyone's like, no, that's just the just the sales ending. It's all fine. So hopefully that is right, and that things are on track for them to cut soon, because everything is priced for that. You can see equities on the top right there looking pretty gung-ho. Credit spreads very calm. Some of the riskiest debt around the world all doing fine. Cryptos come back. So there's certainly nothing here that suggests that US financial conditions are super tight, I would say. Yeah, again, just a warning that there's an overwhelming consensus that the Fed and all the other global central banks have completely nailed it this time, despite the policy errors of recent years. That they've got this, they've got it just right, just enough tightening to bring inflation back in an acceptable time frame, no more and no less, and everything is awesome. So that's a strong consensus, but it's also absolutely the best case scenario. And the world's an uncertain place, and shocks keep happening. Our current account deficit is just a little reminder that we're not having a recession because Adrian Orr thought it was a good idea. We're having a recession because we lived way beyond our means in COVID on borrowed money, not privately borrowed money. And that's why we don't have more blood on the floor in the mortgage market. It was public money. Now, of course, that still has a cost. Our debt is way higher, and we won't be able to do all the stuff that we would like to do in future years because that money's gone. But it has blown out our credit card bill with the rest of the world, not helped by the loss of tourism and foreign students. Now that is recovering now. It's narrowing, and we'll have our preview of the next week's data out later today. But the tourism recovery is definitely helping, but so too is plummeting imports of consumption and investment goods. And that's, you can see in 2009 how great recessions are for the current account deficit. So I guess the upshot of this is we were always going to have to pay the piper for the fact that a negative economic shock came along and we all bought a spa or a jet ski, or at least got some donuts delivered to the door. We did live well beyond our means, and you can do that for a time and not indefinitely. You can see on the right-hand side, the terms of trade are not helping. Export prices down a lot. Now, there are some dairy price increases that aren't in that data, which will show up at the end there, but still a nasty fall in export prices in the light blue, and an unexpected lift in import prices as well. So, yeah, that's only goods, but it is also a shot across the bow for the RBNZ. If they're going to rely on tradable inflation to do the job, then that's a problem. But you can see it can be very, very volatile, but certainly it'd be helpful for central banks if the import inflation keeps dropping away. But, we're in a world that is with challenging geopolitics, a degree of deglobalization and climate change, both effects to decarbonise and also deal with the impacts of climate change as well, increasingly, mostly inflationary shocks, not exclusively. China's, in deflation, for example. But yeah, I agree with what the Reserve Bank said in November, that you can't rely on tradable inflation to bring headline inflation back to target sustainably. But we'll have to wait and see on that one. If you help run a business, we'd love to have you in our Business Outlook survey. It's a great survey. It's got some questions that are looking really, really promising in terms of tracking GDP and stuff, and the nominal side of the economy as well, but more the merrier. If you don't get our research, or even if you do, you can go to research.anz.com and you can see what we've got available and subscribe there. And finally, just a little ad for our podcast. It comes out every morning at 8 a.m. New Zealand time. 5 minutes on what's happened overnight in the markets and the data that came out, and then a 5-minute deep dive with one of ANZ's economists from around the world, looking at some topic du jour, which could be gold, could be oil, could be kind of what the consumer in Australia is doing, could be the outlook for Vietnam. So a more of a global perspective. Available there. And then pages of disclaimers about this not being financial advice. You know that. All right, I'll stop sharing.
Fantastic. I'm glad to hear about that podcast, given I spend an hour in traffic every other week, so no excuses, really. Plenty of questions here, so I'll throw them at you, and I might need to paraphrase some of them and mix some of them together. Excuse me, one question I actually did have. So you talked about the pricing intentions sitting at about 50%, which is about double what it would usually be. Do you know if that sort of additional 25%, are they firms that potentially haven't yet bumped up their prices, or have they been maybe doing it consistently the whole way through? Is there a bit of a pent-up delay there, or is it just sort of consistent across the board that it's just kind of gradual year on year?
Yeah, we can't really tell that from our data. I mean, we could go back and see, you know, how much positive correlation is there. Are you more or less likely to say you're going to raise your prices if you said that last time? That would be quite interesting analysis to do. But I would say there was over 90% of firms at one point were saying they were going to raise their prices. So I wouldn't say there's many firms in their sample that haven't been raising their prices over recent years. But that's an interesting idea to actually go back and look at the unit data. Because, yeah, not everyone's going to raise their prices every quarter. So you can't just annualize that data. You've got to, it could also be seasonal. In terms of that new data, how much are you going to raise your prices in the next 3 months? That could actually be quite seasonal, but we haven't got enough data to tell yet.
Sure, no, that sounds pretty good. Well, then staying on that inflation topic, so obviously this time around, 1970s is with this inflation peak is on everyone's mind. What are your thoughts? What could potentially happen to lead to that secondary round of inflation spikes that everyone's concerned if central banks around the world take their foot off the brake too soon, boom, we're back up to where we were, and we're back to, I think, Paul Volcker's time or whoever it was at the time. So, I mean, that's sort of been banding around, particularly with our investment funds that we're talking to. So, what sort of events do you see need to happen for that to be a global or at least local problem?
Yeah, there's certainly a risk that central banks, they're under huge pressure to ease up because no one likes to cause more pain than is necessary. And as unemployment rises, which is obviously expected to do everywhere, just because of the lags from activity to the labour market, the screaming will get louder to ease up. And so historically, I'd say there has been a tendency for central banks to ease a bit too soon. And you can see from the 70s that you can absolutely get secondary spikes. I mean, in the US data, technically, we've already got a little bit of that. The inflation is technically going the wrong way at the end there. So the incentives are to call victory too soon, which could end up having to hold rates high for longer or potentially raise them again. Of course, in the 2000s, the Reserve Bank didn't ease, but three times they called a stop to hikes and ended up hiking again. So, our forecast that they'd raise again after a pause is just actually quite normal. But I was obviously wrong. But that's why I still wouldn't rule it out. Because of that potentially spinning wheels, that 5.5% OCR could effectively get lower even as it stays still over time, and it could need a top up in the future. But I don't. Powell sort of said he thinks that he's close to the point at which they can cut rates. So the market is certainly keen to believe that this is all over, bar the shouting. But inflation is actually really hard to forecast and surprisingly difficult. You would think it would be easier, but it's really, really hard. And so I just wouldn't rule out any scenario at this point. Maybe that January data in the US was the start of something ugly. Maybe it was just a bump in the road and they will be cutting by June. But I would just say that markets are very much discounting any possibility that there was anything worrying at all in that data. But we'll know more tomorrow. Overnight. It'll be really exciting, that CPI data coming up.
So in that case, do you have any opinions on the rally that we've seen out of the US at the moment, or specific share markets, and whether they're getting ahead of themselves, or is that not really an area you pay too much attention in?
Oh, I certainly don't forecast equities, but it is an interesting one because the US consumer has a lot more weight on equities in their wealth portfolios than we have in New Zealand, where it's all about house prices. So this rise in equities is easing financial conditions, all else equal, and making people likelier to spend. So that is something that the Fed will have to take into account. I realise there's something else I want to say in the previous question. Why would we worry about inflation taking off? Well, basically, you'd have to see inflation targets getting softened. And that is a risk. We've already seen a bit of a debate in New Zealand. Well, if it's true that imported inflation is going to run higher because of climate change or geopolitics or whatever, then would we really want to screw the domestic economy down into deflation to offset that, or should we just accept higher inflation for a period? And that is a debate that's worth having. BNZ's been coming out with some stuff. It's all insurance and rates, and the RB can't do anything about that. So they should just chill out and let inflation be high for longer. The risk with that is, of course, that it becomes normalised and builds your expectations, and 4% inflation becomes the default. And so the RBNZ did push back quite hard against that notion. Also, the increase in insurance is partly the construction costs, which is something monetary policy can affect, for example. And similarly, rates will have that element in it too, and the wage inflation. So it's not prices that the Reserve Bank directly impacts, but indirectly it is part of the overall picture. At the end of the day, central banks don't set their targets; the politicians do. And at the moment, of course, our government's gone the other way and gotten rid of any extraneous noise around the inflation targeting and said, fix this. But you can imagine scenarios in the future, particularly if it's supply shock driven inflation that's bad for growth anyway, like an oil shock, for example, that the pressure might come on central banks to ease up. And if that were to happen, or that there's something to do with the incredibly high level of government debt. Everyone seems to think that because the debt's public, it's risk-free. You look at US, the trajectories for US government debt, and this is the world's risk-free asset, and they're about to re-elect Donald Trump. I can't see much risk-free about US debt, but it's the numeraire. The risk of everything is relative to US treasuries. So, yeah.
Okay, then so feeding back then to the GDP, you talked about the sort of the real GDP. What about GDP per capita? Because that's not such a rosy picture, and we're not getting high income earners coming into the country. It doesn't seem to be, I guess it's well publicised, but not often discussed. What are your thoughts on the GDP per capita aspect and the infrastructure requirements off the back of the net migration that we're seeing and the affordability of it?
Yeah, so per capita GDP is down nearly 3%, or around 3%. So, the overall GDP has been flat and the population's growing nearly 3%. So, yeah, absolutely, on a per capita basis, we're in a recession by anyone's definition. But is it per capita demand or total demand that matters for inflation pressures? Because you can imagine that the number of firms in the various sectors, apart from maybe ethnic restaurants, is not going to rise as quickly as the population is rising. So shops will see more demand for a period until more shops emerge. And the big sticking point is, of course, housing supply, and the inflation that we could see there. So it will quite reasonably lead to a period of excess demand for goods and services and infrastructure. We still haven't caught up with the infrastructure we need from previous population growth, and now we've let in 250,000 people, and I mean a bunch have left as well, but still it's a decent sized city by New Zealand standards has arrived, and the house building is declining. So that's why I'm just not convinced that fiscal policy is going to be meaningfully contractionary in the near term or in the medium term, because we just have to build so much stuff, and the whole world is trying to build so much stuff at the same time. Australia is talking about their terrible infrastructure deficit. I was over there last week. Everything's new and shiny. Their public transport is amazing, and they're talking about their infrastructure deficits. Like, tried getting from A to B in New Zealand. So it's going to be a global battle for those resources, and that's going to be inflationary.
Yeah. Okay. I think I've answered, or at least asked the questions. Finally, anything on the Aussie US currency? Do you have sort of any positions on what from a New Zealand perspective versus the AUD or the USD?
So Australia's also very exposed to China, of course. I think both currencies have had a bit of a lid on them because of that perceived China risk, which is obviously pretty real. Australia's more exposed to their investment, us to the consumer, but both are under pressure. I would say, the iron ore price has not been doing well, nor has the milk price particularly. You can actually look at the relativities of those two prices, and explains the cross rate pretty well. But that 5% growth target does seem to be, as I saw it described, a target without a plan. They're not actually planning on doing a big infrastructure build to boost GDP the way they used to. They are quite concerned about debt, and they can't slash interest rates either, because they're worried about the net interest margins of their banking sector and what that would do to that sector's profitability. So they've actually run out of levers to pull to get to that GDP growth target, except for maybe leaning on the staff of the statistics department, which is what time-honoured strategy one suspects in China. Not that I know that, but Yeah, it's hard to see either investment or consumption in China doing very well. So it's in Australia and New Zealand. It might come down to rate differentials, um, really, and at this point we're probably more confident that the RBA will be in a position to cut quicker than the RBNZ, partly because their pass-through is so much quicker. Most of their
Floating.
mortgage debt is floating.
Yeah.
And their household debt's higher, quarter of GDP higher than in New Zealand. So they do get bang for their buck, which I think explains why their policy rate has peaked so much lower than ours.
Okay. All right. Well, I think that is everyone. Hopefully I didn't miss any of those questions off. I guess, as per usual, thank you very much. I really enjoyed having you along. Um, keen to hear your views and how you portray that through the market. And I know from how many people we get on, we certainly get a good bump in numbers when we have you appearing. So thank you once again. Hopefully see you soon. And again, everyone for joining. Thank you very much for joining. The recording will be available for a few weeks until it becomes whatever the word you use, it gets old.
Out of
Um,
date.
Out of date, that's one way of looking at it.
Yeah.
And
Keeps
yeah, from
moving.
myself, Roger, Jack, Kerry, and Grant, thank you all once again. And yeah, we'll see you all in the next one.
Thanks.
Thank you.